Hello everyone and welcome to a new video. In today's video, we'll be discussing the volume profile tool and how we can use the volume profile tool to identify premium and discounted pricing zones. Now, before we get into the video, I wanted to let you know that I have released a full market structure course. Includes 12 lessons that will take you from basics to intermediate to advanced levels. It covers market structure extensively and will allow you to understand how we can use market structure to increase our probabilities when trading. Also, it covers multi-time frame analysis step by step, alongside how we can utilize the volume profile tool in order to validate market structure. And yeah, it's priced at £44.99 and the link will be in the description. Now let's get into the video. Why is premium and discounted pricing zones so important? Identifying premium and discounted pricing zones provides us with the highest probability order blocks. Now, in order to identify where exactly the premium and the discounted pricing zones are, we must first determine the equilibrium price level, which is also referred to as the midpoint. Now, the equilibrium price level is where supply is equal to demand. This is the midpoint of a price level or the midpoint of a swing on the charts. Hence, we say that the equilibrium is seen as a fair value price level. Prices are not expensive nor cheap for both buyers and sellers. They are simply balanced. So there is no excess demand where we would have more demand than there is supply, nor is there excess supply where we would have more supply than there is demand. It is simply where supply and demand, or buyers and sellers, agree and meet. So how can we use the economics demand and supply model to illustrate the equilibrium? So as we can see, the equilibrium price level is simply where supply and demand intersect. Right? This is where supply is equal to demand, or where sellers is equal to buyers. So it's seen as a fair value price level, as this price level is not too expensive nor too cheap for both buyers and sellers. So what exactly are discounted pricing zones? So discounted pricing zones are below the equilibrium level, which is our midpoint, our fair value price level. This is because below the equilibrium, right, prices are deemed to be too low or too cheap, which causes excess demand. This is because there's a far greater amount of buyers who are willing to buy at these cheap price levels, and even fewer sellers who are willing to sell their short positions to these buyers who want to buy them. Because guys, what you have to remember is the markets are a two-way auction. For every buyer, there must be a seller, and for every seller, there also must be a buyer, right? And as prices fall below the equilibrium price level, prices are obviously getting a lot cheaper. So when prices get cheaper, demand increases, but supply falls, because obviously we have a lot of buyers who want to buy at cheaper prices, but even fewer sellers who want to sell their short positions at lower prices, because the sellers, they profit the most when selling at higher prices, and the buyers, they profit the most when buying at the lowest possible prices, right? So below the equilibrium, what we say is that the buyers absorb, or they buy all the short positions that are available to be sold at these cheap price levels, which causes prices to skyrocket. Because guys, what you have to remember is, although we have a limited amount of sellers below the equilibrium price level, because obviously prices are too low, there are still sellers who are still there, who are still available and willing to sell their short positions to the buyers. So what happens is that the buyers, what they will do is they will try and buy as much short positions as they can at these lower prices. And once that occurs, we have excess demand, because we have a lot more demand than there is supply, a lot more buying than there is selling. So this causes prices to rise drastically in order to clear the excess demand. So as a result, we only look to long the market of points of interests that lie below the equilibrium level, or order blocks that are below the equilibrium level in discounted pricing, which become the highest probability order blocks. Now, what exactly is premium pricing? So premium pricing is the opposite concept, right? So premium pricing zones are above the equilibrium price level, which is our fair value price level. This is because above the equilibrium, right, prices are deemed to be too high or too expensive, which causes excess supply, right? This is because there's a far greater amount of sellers who are willing to sell their short positions at these expensive price levels or at these higher price levels, and even fewer buyers who are willing to buy their short positions. Because guys, what you have to remember is, as prices increase above the equilibrium price level, right, this becomes a lot more attractive for the sellers to sell their short positions, because obviously they want to sell at the highest possible prices. But as a result, what happens is that the demand declines, right? So as supply increases, we have a lot more sellers who want to sell higher at higher prices. The demand also falls because buyers, they deem these prices to be too expensive for them to enter the market. So what happens is the sellers, what they will do is they will sell as much of their short positions to all the buyers who are available at these expensive price levels, which causes prices to fall drastically. Because, guys, what you have to remember is although we have a limited amount of buying and demand at these premium pricing zones, there are still some buyers who are still there. So what the sellers will do is they will attempt to sell as much of their short positions to all the buyers who are available to buy their short positions at these expensive prices. So the sellers have sold as much short positions as they can, which causes prices to fall drastically due to excess supply. And as I said, excess supply is where we have more selling than there is buying. And the only way for the market to clear the excess supply is through falling. Hence, we only look to sell the market of points of interest that lie above the equilibrium level, or supply zones or order blocks that are in premium pricing become the highest probability order blocks. So, how can we measure the equilibrium, the premium, and the discounted pricing zones? We use something called the volume profile tool. Now, the volume profile tool is an institutional indicator, right? And it represents the volumes at each price level. And what we want to do is we use the volume profile tool and drag it in between our swings. For example, if we're in an uptrending market, we drag it from the higher low to the higher high, or if we're in a downtrending market, we'll drag the volume profile tool from our lower high to our lower low. Now, the point of control, which is the red line, represents the equilibrium price level. And the point of control, it shows the most traded price level throughout the swing, right? And the point of control, or the POC, is where the institutions have accumulated the largest majority of their positions, right? And the POC represents the equilibrium. As I said, it's where supply is equal to demand. Now, knowing this, we now know that anything that is below the point of control is discounted pricing, and anything that is above the POC is our premium pricing zone. Now, how do we use the volume profile tool? So in an uptrend, what we do is we drag the volume profile tool from our higher low to our higher high. This gives us our discounted pricing zone, which is the zone at the POC and below, right? And this is where we have a large concentration of buy positions accumulating because buyers deem these price levels to be affordable and cheap, causing any order block or demand zone within our discounted pricing zone to be highly probable because the market is likely to respect it as we expect prices to go up from our discounted pricing zone. Whereas in a downtrending market, what we do is we drag the volume profile tool from our lower high to our lower low. This gives us our premium pricing zone, which is anything at the POC or the equilibrium and above, right? And this gives us the area where we have a large concentration of sell positions accumulating because, again, sellers deem these price levels to be high enough and good enough for them to sell their positions. Hence, any supply zones that are created in the premium pricing zone are seen to be highly probable. Examples, some on euro dollar. And the first thing that you want to do is identify the trend. So currently, euro dollar was uptrending, right? It was creating higher highs, higher lows, higher high, higher low, a higher high. And this gives us our break of structure over here, right? And then what happened? What happened is that the market broke below the previous higher low, which created this higher high. And when that occurs, that forms a bearish change of character, right? This occurs as soon as the market breaks below the previous higher low, which was this one, that made a higher high. And this bearish change of character suggests to us that the market has shifted from an uptrending market where it was creating higher highs and higher lows to now a downtrending market where it's creating lower lows and lower highs. Now, we obviously know that price has to go down in order to create a new lower low. And to catch this down movement, we want to be entering off the most powerful supply zones. And as we know, the most powerful supply zones are in premium pricing, right? Because premium pricing is where we find the heaviest concentration of selling accumulating, because sellers deem these price levels or premium pricing zones to be acceptable for them to exit their short positions. Now, to identify your premium pricing zone of the swing, what you want to do is drag your volume profile tool from your most recent lower high to the lower low, right? And our premium pricing zone is anything that is at the POC, so it's over here and above, right? So this is our premium pricing zone, right? So this is where we will find the most powerful supply zones, right? So as you can see, we have a supply zone over here, right? However, this is not a valid supply zone because, as I said, we only want to be entering of the most powerful supply zones, and the most powerful supply zones lie in premium pricing, right? So we can go ahead and identify this as a powerful supply zone that we will be interested in entering of, because obviously it's in premium pricing, right? And as you can see, the market came towards it and rejected off it nicely, because again, it's a powerful supply zone, has inducement over here, right? We have a lot of liquidity build up just before this supply zone, right? And also it's in premium pricing, which is the main point. Let's have a look at another example. So the first thing you want to do is identify your trend. So we can clearly see that the euro dollar was creating lower lows, lower highs, lower lows. And then what happened is that the market created this bullish change of character over here as price broke above the most recent lower high, which was this one, that made a lower low, confirming that this is a bullish change of character. And when we get a bullish change of character, this suggests that the market has shifted from a downtrending market where it was creating lower highs and lower lows to now an uptrending market creating higher highs and higher lows. So what we want to be entering off is the most powerful demand zones. And as we discussed, we find the most powerful demand zones in discounted pricing, right? And to identify your discounted pricing zone of the swing, you simply drag your volume profile tool from your higher low to the higher high, right? So like this. So we have a few demand zones. We have this demand zone over here, but clearly this demand zone failed because it's a weak demand zone, right? It's not in our discounted pricing zone. Our discounted pricing zone is anything at the POC and below. So this is where we would find the most powerful demand zones possible, right? And we can clearly see a nice demand zone over here, right? That was respected because it's in a discounted pricing zone, whereas the demand zone above, which was not in a discounted pricing zone, completely failed because it doesn't meet the criteria of being a valid demand zone. The most important thing is that it has to lie within discounted pricing, because remember, discounted pricing is a pricing zone that buyers deem to be affordable and cheap, which means that at discounted pricing zones, we have a large buying concentration accumulating, right? So over here, we don't have those buyers appearing at this demand zone because obviously it's not in a discounted pricing zone. Guys, I wanted to go ahead and show you using the volume profile on the higher time frames. So I'm on pound CAD, and the first thing, as always, that you want to do is identify your higher time frame trend. So we can clearly see that the daily time frame is uptrending, right? It's creating higher lows and higher highs, higher low, a higher high. So we can go ahead and label that as a break of structure, right? And then what happened is that price broke below the previous higher low, which was this one, right? That formed this higher high. We can see that this higher low made this higher high, right? So this is a change of character as price broke below the previous higher low, which was this higher low that formed this higher high, right? So this created a bearish change of character, which suggests that the market has shifted from an uptrending market where we were creating higher highs and higher lows towards now a downtrending market, creating lower lows and lower highs. Now, the second step that you want to do is identify your premium pricing zone, and you do so by dragging your volume profile tool from your daily lower high to your daily lower low. Now, this gives us our premium pricing zone, which is anything at the POC and above, right? So it's this whole zone over here. This is our premium pricing zone, right? Now, this is the zone where we would find the most powerful supply zones, right? Because obviously we have a large accumulation of sell positions accumulating at this zone, as sellers deem this zone to be acceptable for them to exit their short position, right? So we can go ahead and label this supply zone as invalid, right? Because it's not in a premium pricing zone, right? We can clearly see that this supply zone is below the premium pricing zone, right? We only want to be entering of supply zones within this zone. So just go down to the 4-hour, right? And I can see a nice supply zone over here. You can see this nice supply zone over here, right? It's within our premium pricing zone. It had imbalances created afterwards, and we also had this inducement over here, right? So what happened is the market came and tapped into it perfectly, right? We can see how aggressively the market rejected of this supply zone, because obviously it follows the criteria of a valid supply zone. And the main and important thing is that it's in a premium pricing zone. And yeah, thanks for watching the video. I hope you understand how we can use the volume profile tool in the context of premium and discounted pricing. And be sure to check out my website, which is in the link in the description. And I'll see you guys in the next video.